Hey guys, we have a different type of episode that we're dropping today than what we had planned. This is another example of us dropping podcasts on both our New Money, New Problems and Escape Student Loan Debt platforms. For compliance reasons, I have to make sure you know those are two separate businesses. But when we have student loan information that comes out that's urgent and relevant, we often post it on both platforms. I definitely had another episode in the queue that I was planning to release, or we were planning to release, but I have had to pivot for the second time in 2 weeks because the Senate just released their version of the One Big Beautiful Bill Act in terms of the revisions that they are making when it comes to student loans. And there's some information in here, definitely when it comes to Parent Plus borrowers, that's like extremely urgent and maybe less urgent, but still important information for all income driven repayment plan borrowers, because I would say that when you look at how these bills are passed, again, going back to Schoolhouse Rock, if you remember the progression, it starts in the House has to pass it, it goes to the Senate has the ability to make revisions or to accept the House version. If they make revisions, they send it back to the House, and they're essentially trying to get to the point where both chambers are approving the same legislation. And as the House bill was very punitive, we were hoping that the Senate version would come out and would show that they were not marching in the same step or marching in the same direction, and that they would, make the bill a little less punitive. I would say that unfortunately, which speaks to the urgency of the episode, not only are they moving in the same step, I would say that in some instances, the Senate version is even more punitive than the House version. So we wanted to make sure that we got this information to you quickly. We're not going to spend as much time on information that impacts future borrowers more so than current borrowers, but there is some still devastating information for future borrowers, just like the House version, which placed lifetime limits on how much you can borrow. I think in the House it was $50,000 for undergrad, $100,000 for graduate school, and then $150,000 for like a professional program, which I interpret as like a medical school or a law school. The Senate still places caps, but they increased it slightly. So you can go up to $200,000 for a professional program under the Senate version. But again, that still is less than half of what it takes to go to some medical schools and dental schools and even law schools in some instances. So still really devastating, because if you are faced with the option of either not going to medical school or law school, or taking out the max in federal student loans and getting private loans, which can be more predatory. Not all people can even, qualify for private student loans. Most people are going to try the private student loans route. And as much as federal student loans can really damage your finances, private student loans have far less options in terms of manageable payments and getting out of the situation without being able, or I should say without damaging the rest of your financial plan. So not really a positive, but unfortunately it is something that stayed put in some format with the Senate version. Moving forward to people who are current borrowers, they also, I would say, solidified some of the things in the House version and made more punitive some of the things in the House version as it pertains to repayment plans. In the House version, you may recall, if you listen to the episode, that they were proposing eliminating all income-driven repayment plans except two. So if you are a current borrower, meaning you have student loans, you're already out of school, they were saying that you would only be able to sign up for either the old version of the income-based repayment plan, not the new version, which had lower payments and a shorter repayment time, or the newly created repayment assistance plan, which from the calculations that I've done, in most cases has a higher payment than even the old income-based repayment plan, although I'm sure there are some exceptions. For future borrowers, and future borrowers meant starting after July 2026, you would not even have the option of the old IBR plan. You would have to use the repayment assistance plan if you were trying to use income-driven repayment plans, or even pursuing public service loan forgiveness, which requires you to use an income-driven repayment plan as one of the regulations. So for a future borrower, that would be the only plan that they have the option to pick. And it's something that, again, is just very punitive to take people who may be on pay as you earn or new income based repayment, where they're paying 10% of their discretionary income for 20 years. Under old IBR, they'd be paying 15% of discretionary income for 25 years under repayment assistance plan. And we're going to end up doing a full episode on how that payment is calculated. They would pay a percentage of your adjusted gross income. It's not based off of discretionary income. For most high income earners, it would be 10% of adjusted gross income, and you'd have to pay it for up to 30 years before any remaining balances will be forgiven. So just a far worse option as compared to what is currently available. Well, the Senate version confirmed that and made it worse. So not only are they trying to make sure that old borrowers, or should current borrowers, only have access to old IBR and repayment assistance plan, new borrowers only have access to repayment assistance plan, they have also changed the calculation for married borrowers who would file taxes separately as compared to what the House proposed. So if you listen to this podcast in the past, you know that if you are a federal student loan borrower and you have a spouse that earns a high income and you're on an income-driven repayment plan, you may not want that spouse's income, included in your payment calculations, especially if they don't have student loans. One way to avoid doing so would be to file your taxes married filing separately. And based on the way the rules currently work, you would be able to exclude your spouse's income, but you would be able to include them as a member of your household when it came to your federal poverty level, which helps decrease your payment. So excluding the income helps decrease your payment, but including them in the federal poverty level helps decrease your payment as well. Well, with the Senate version, for a repayment assistance plan, unlike the House, which would still allow you to file taxes married filing separately and exclude your income, the Senate version takes away that option. So we did our urgent updates webinar on student loans on Tuesday. We were actually just about to release the replay. And in that replay, I was saying, hey, at least they're still allowing you to file your taxes married filing separately. So there was some strategy that could be done. In this version, they're saying it doesn't matter how you file your taxes, your spouse's income is going to be included. And that is a potentially devastating loss of a strategy that many borrowers use when they're in a high income earning relationship. For example, and we'll try to put this on screen, if you are looking at repayment assistance plan, and again, we'll do a full episode on how that payment is calculated. If we had a family of four and they made $100,000 of adjusted gross income, on pay as you earn and new IBR, they'd be paying $431 a month. On old IBR, they'd be paying $647 a month. On repayment assistance plan, they'd be paying $733 a month. So that's $100,000 adjusted gross income, family of four, filing their taxes together. By losing access to pay as you earn and new IBR, you're talking about a difference of over $200, in some cases over $300 a month, based on the two options that would be available for current borrowers. But if we take that a step further and we remove the option of filing separately, you can see the loss of a valuable strategy. So let's say that we have a family of four, $100,000. Let's say that both people in the relationship earn $50,000, but they file their taxes separately. Well, based on the way that calculation works, under pay as you earn and new IBR, they would only pay $15 a month. On old IBR, they'd pay $22 a month. But on repayment assistance plan, because there is no strategy involved in this process, they'd still be stuck at $733 a month. So you look at that from a planning perspective, you're talking about a $700 monthly difference based on the strategy that you used to have access to that we potentially will lose if this passes as is proposed. So that's a terrible circumstance. This bill, when it comes to public service loan forgiveness, it also follows through with not allowing medical and dental residents to receive credit for public service loan forgiveness for the years that they're in training, which again is devastating as well. But to me, for all the people who are losing things in this, the most damaging are parent plus borrowers, people who took out loans on behalf of their children with the anticipation of being able to lower payments through income-driven repayment plans or pursue public service loan forgiveness. And the way that they would do that is through a process called the double consolidation loophole. We are going to post a link to the episode where we went through that in detail. And we actually, in future episodes, are going to have to revisit that just because there's going to be people who are some really, really under the gun. But this is urgent if you are a parent plus borrower. The Senate version confirms what the House proposed, meaning that if you have Parent Plus loans, when this goes into effect, they will not allow you to use an income-driven repayment plan. They will not allow you, once the window closes, to do the double consolidation loophole, which means that not only can you not receive forgiveness through income-driven repayment plans, you also can't pursue public service loan forgiveness if you're a Parent Plus borrower. They're going to force you to repay it. Now, what this says to me is that if you have Parent Plus loans, you need to act urgently in either pursuing the double consolidation loophole so you can get on at least old IBR. But in the new version, the Senate version, they're doing away with even, income contingent repayment, which is one of the options that currently exists. Now, what they are saying is if you had Plus loans that are already on income driven repayment, then you're fine. So we're really talking about people who haven't enacted this strategy yet, which is what makes it so urgent. What I would say is at minimum, at maximum, I would start pursuing the double consolidation loophole right now, hoping that you can get in by the skin of your teeth before this all changes. However, the thing that complicates that recommendation is these applications that are for income-driven repayment plans are still in limbo. At last count, there were over 2 million applications that still hadn't been processed just to switch income-driven repayment plan options or sign up for an income-driven repayment plan option. So the double consolidation loophole can take months. Just as a high-level overview, you have to do paper applications. You have to submit your applications to 2 different loan servicers on the first round of consolidations. Then you have to consolidate them again online into a single third loan servicer. And it can take months and months and months. I'm talking about it could take 6 months easy if you're trying to pursue that. And you may be worried that if it takes a year, then you would lose your opportunity and be stuck with just paying it back in full. If you're concerned about that, an option that you would have would be to, instead of doing the double consolidation, just consolidate one round of your Parent Plus loans right now. Student loans are really weird. Federal student loans are even weirder. But even if you only have one Parent Plus loan, you can still consolidate one loan. As crazy as that sounds, it doesn't make sense in terms of the meaning of the word, but in terms of how federal student loans work, you can actually consolidate a single loan. Once you consolidate a single loan, you can take that Parent Plus loan and you can use income contingent repayment plan to pay back that loan. It's a terrible option under income driven repayment, but it is an income driven repayment plan. So the hope would be, we don't know yet, but the hope would be that if you're at least on ICR, that when that plan goes away, that they would allow you to take your loans and put it on old income based repayment plan. Again, we'll see if that's the case, but to me, that would be the minimum thing that I would do, hoping that you, again, get in by the skin of your teeth if you're worried about the length of time to process the double consolidation loophole. So again, in future weeks, we'll talk more about that loophole. We'll talk more about exactly how to go through the process. Loophole implies illegality. It is a legal step that you can do with your student loans. It just requires a different process. But if you have Parent Plus loans already, I'm saying tomorrow, if not right now, you need to be starting the process, if you're not already, of signing up for an income-driven repayment plan or getting closer to an income-driven repayment plan. And beyond that, if you have students that are, your children that you are planning to support, and you are planning to do so potentially through a Parent Plus loan, if this passes, I would say flat out don't do that. There's got to be another option, whether it be them going to a different school, whether it be them taking out student loans on their behalf. If they're capped out, I don't know. I really don't know, but I know what an option isn't, and that would be taking out a Parent Plus loan after this has passed, because your options for repayment have been severely reduced. So unless you're taking out something that's way less than your annual income and it wouldn't be tough to repay, that's a different story. But if you're like most of the Parent Plus borrowers we see, where you are banking on that income driven repayment plan or public service loan forgiveness, under this version that will be closed, and you need to act accordingly. So again, maybe what we had planned to post today, in the future we will post, but this has changed a lot. It's even changed some of the things we talked about in the webinar on Tuesday. So we are posting this on both platforms. I would ask that you share this with anybody who has federal student loans. If you have questions that you want us to cover in future episodes or about your specific loans, we're working through a process where we're going to be able to do more individual consultations and things of that nature, because I think it's going to be needed in the months ahead. So, unfortunate news. I wish I had a pleasant surprise as to why we were making this pivot, but this is where we stand. There is still hope in the sense that this bill hasn't been passed. So, as I encouraged you to do when I unveiled the House version, I would encourage you to reach out to your senator and let them know how unpalatable this is as a federal student loan borrower, and that you disapprove, because I definitely disapprove. But hopefully in the months to come and in the years to come, we can add some value to help you have your student loans forgiven, reduced, reorganized, or expedited. But today it got just a little bit harder. I'll see you soon.